Good morning, everyone. This is Marshall Giller bringing you the morning comment for March 11th. Nothing new today. The dollar just keeps on soaring and the euro just keeps on collapsing. Eurodollar and the DXY index are back at levels last seen in 2003. The dollar's strength is particularly remarkable given that the action in the U.S. rates market hasn't been dollar supportive. The sudden change in the market is really remarkable. Eurodollar was basically in a 30-cent range for most of the 10 years from 2004 to 2014. But from March 2014 to now, the range has been 32 cents. And half of that's come just since the start of 2015. Some of the volatility may be associated with the beginning of the Fed's tapering off of its quantitative easing program in January of 2014. However, the big change recently has been ECB policy. I believe that foreign investors who have been big buyers of euro-denominated bonds have been taking profits ahead of quantitative easing and have been repatriating their money. In fact, net outflows from European assets have recently been running at a record high. While foreigners apparently have been buying European stocks, the flows in exchange-traded funds show that they've been doing so on a currency-hedged basis. So there's been no impact on the currency market. More to the point, I'd guess that foreign investors got used to Eurodollar being steady and so weren't hedging their positions at all. Now, however, they're rushing to hedge, which is exacerbating the decline. My conclusion, the exodus from European bonds and the hedging activity of investors is likely to continue for some time, meaning these trends are likely to remain in place for the long term. This morning, China released retail sales, industrial production, and fixed asset investment figures. They were all below estimates. The news is likely to weigh on the Australian dollar and New Zealand dollar today. We have a relatively light day for indicators today. UK industrial production for January is forecast to have risen after falling in December. This would be the first rise after 3 consecutive months of decline, and so could prove positive for sterling. ECB President Mario Draghi and 3 of his governing council colleagues will be talking today, in addition to Bank of England Monetary Policy Committee member Martin Wheel. The big action, though, is going to be overnight when the Reserve Bank of New Zealand holds its policy meeting. The bank is expected to leave its policy rate unchanged at 3.5%. Since its January meeting, the New Zealand dollar strengthened and economic data haven't been that supportive. This makes it possible that the bank will maintain its neutral bias or even cut rates, in our view. The market view is that the RBNZ will hold rates steady. The overnight index swap market's assigning a 92% probability to that outcome, while 11 out of 13 analysts surveyed on Bloomberg also thought there was likely to be no change. But, on the contrary, we believe that a 25 basis rate cut seems likely, instead of the governor just trying to talk down the currency again. Given the market positioning, this would be quite a shock to the market, and we would expect the New Zealand dollar to depreciate substantially if it happens. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.